Markets are tumbling, but there's one boring ETF that's quietly outperforming. The stock market just crashed this week. Tech stocks and growth names are sliding hard. But one type of investment that's actually thriving right now may surprise you. And it isn't flashy. Today, I'm breaking down why a boring dividend ETF called SCHD could be one of the safest ways to invest during a market crash in 2026. Earlier this week, major indexes dipped sharply as investors fled high-valuation growth stocks and risk assets. Tech names, which had driven the rally for years, took big hits, dragging indices down. This kind of volatility reminds us that stocks don't always go up, especially when investors start rotating money out of expensive sectors. And when that happens, safe, income-producing investments tend to outperform. Here's the core investing truth. When the market crashes, income becomes more important than hype. Dividend-paying companies are typically established, profitable, committed to returning cash to shareholders. These traits make them less volatile than many speculative growth stocks. Dividend-focused ETFs can provide both stability and income, which helps cushion your portfolio when everything else is dropping.
This content is for educational purposes only and is not financial advice. Investing involves risk, including the possible loss of principal. Always conduct your own research and consider consulting a qualified professional before making any investment decisions.
So, with that important reminder out of the way, let's dive into one of the most talked about funds in the dividend investing community. What exactly is SCHD? The ticker stands for the Schwab U.S. Dividend Equity ETF. At its core, it's an exchange-traded fund designed to track the performance of the Dow Jones U.S. Dividend 100 Index. This isn't just a random collection of stocks, it's a carefully curated portfolio of approximately 100 US-based companies chosen for their financial health and commitment to paying dividends. The selection process is what truly sets SCHD apart. It starts with a broad universe of US stocks and applies a series of rigorous filters. First, it looks for companies that have paid dividends for at least 10 consecutive years, establishing a baseline of reliability. From there, the remaining stocks are ranked based on 4 fundamental metrics: free cash flow to total debt, return on equity, indicated dividend yield, and 5-year dividend growth rate. The top 100 companies that pass this multi-layered screening make it into the fund. This methodology ensures the portfolio is filled with companies that aren't just paying dividends now, but have the financial strength to likely continue paying them in the future. The fund is then rebalanced quarterly to maintain this high-quality standard. This focus on fundamentals results in a portfolio of household names and industry leaders. You'll often find giants from sectors like financials, industrials, healthcare, and consumer staples. Think of companies that provide essential goods and services, which tend to generate stable cash flows regardless of the economic climate. This focus on reliable income stands in contrast to funds that chase flashy, high-growth tech stocks, which can be far more volatile. So why has SCHD become so popular? A huge part of its appeal lies in the powerful combination of a solid dividend yield, broad diversification, and an exceptionally low cost. Historically, SCHD has offered a dividend yield hovering around 3.5% to 4%. This is often significantly higher than the yield of the broader S&P 500, making it an attractive source of passive income. Furthermore, it achieves this with a rock-bottom expense ratio of just 0.06%. That means for every $10,000 you invest, you're only paying $6 per year in management fees. This low cost is a critical advantage, as it allows more of your money to stay invested and compound over time. Finally, by holding around 100 different stocks across various sectors, the fund provides instant diversification, which helps mitigate the risk of any single company performing poorly. That's one of the main reasons many dividend investors see it as a safer and more predictable vehicle for long-term wealth building than trying to pick individual stocks or riding the roller coaster of concentrated technology funds. It's built for stability and income, first and foremost. So, how does an ETF like SCHD typically behave when the market gets choppy? This is where its defensive nature really comes into focus. During periods of market stress, when high-flying growth stocks and major indexes like the Nasdaq 100 are experiencing significant pullbacks, SCHD has historically shown remarkable resilience. We've seen this play out time and again. While tech-heavy funds might drop by double-digit percentages, SCHD often weathers the storm with much smaller declines, and in some cases has even managed to stay positive. This isn't a coincidence. It's a direct result of a phenomenon called sector rotation. When fear and uncertainty rise, big money investors often pull their capital out of riskier, speculative assets and move it into what they perceive as safer territory. They're looking for stability and a reliable return, which leads them directly to defensive, dividend-producing companies, the very heart of SCHD's portfolio. This flight to safety can create a floor for SCHD's price, cushioning it from the worst of a downturn. The reason for this resilience lies in its construction. Unlike many popular ETFs that are heavily weighted towards the technology sector, SCHD deliberately tilts its portfolio toward more defensive areas of the economy. We're talking about sectors like consumer staples, healthcare, industrials, and financials. Think about what these sectors represent. Consumer staples are the companies that produce the food, drinks, and household products you buy every week. Healthcare includes the pharmaceutical giants and insurance providers whose services are always in demand. Industrials in SCHD are often mature, established companies critical to infrastructure and logistics, and its financial holdings tend to be large, stable banks and insurance firms, not volatile fintech startups. These industries tend to hold up better in downturns for a very simple reason. They sell essential products and services that people and businesses need, no matter what the stock market is doing. You're still going to buy groceries, pay your electricity bill, and fill your prescriptions even if the economy slows down. This creates a consistent and predictable revenue stream for these companies, allowing them to maintain profitability. And most importantly for SCHD investors, continue paying out those reliable dividends. This underlying business stability is what makes SCHD a potential stronghold in a volatile market. Another huge benefit of SCHD is its powerful cash flow component. Unlike growth-focused investments where your returns depend solely on selling your shares for a higher price, SCHD provides a more tangible reward: dividends. Think of dividends as a share of a company's profits, paid out directly to you, the shareholder, typically on a quarterly basis. This creates a steady, predictable stream of passive income. When you hear analysts talk about dividend yield, they're referring to the annual dividend per share divided by the stock's current price. For an ETF like SCHD, this yield represents the income return you can expect on your investment. Rather than just hoping for price appreciation, SCHD pays investors regularly, giving you a tangible paycheck even when the market is volatile and prices fall. For many investors, especially retirees or those building wealth conservatively, that dividend income can be the difference between panicking during a downturn and staying confident in their strategy. Imagine you have a $10,000 position in SCHD. With a hypothetical dividend yield of 3.8%, that translates to $380 in passive income per year, paid out in quarterly installments of about $95. This income can supplement Social Security, cover small bills, or be reinvested to buy more shares through a dividend reinvestment plan, or DRIP. This is where the magic of compounding truly shines, creating a dividend snowball that grows larger and generates more income over time, all without you having to sell a single share. And because SCHD specifically screens for dividend quality and consistency, those payouts are designed to be more reliable over time compared to speculative, high-yield stocks that might be dividend traps. The fund's methodology looks for companies with a strong history of paying dividends and healthy fundamentals, including a sustainable payout ratio. This means the companies aren't overextending themselves to make payments, reducing the risk of a sudden dividend cut. This focus on quality provides a defensive layer. While no dividend is ever guaranteed, SCHD's portfolio is built on a foundation of companies that have weathered economic storms before, making their income stream a more dependable component of your investment plan. Right now, SCHD's yield sits near around 3.74%, much higher than the S&P 500's average, and its exposure to tech sectors is very low relative to growth funds. That means while the tech market crashes, SCHD's focus on stable dividend payers reduces downside volatility. Investors who aren't chasing growth may find this boring, but reliable ETF gives them peace of mind in choppy markets. So why invest in SCHD now instead of holding everything else? Better stability in downturns. Dividend income you can reinvest or spend, broad diversification versus individual stock risk, low fees and transparent holdings. In a market where risk assets are selling off, dividends matter more than ever. Now, full disclosure. SCHD is not risk-free. Dividends can be cut, prices can still fall. Past performance doesn't guarantee future returns. Returns may lag high-growth sectors in bull markets. But for many investors, especially in a crash, reducing risk and capturing income beats chasing quick gains. If you want to use SCHD as part of a safer investing strategy, don't go all in. Diversify across assets. Consider dividend reinvestment. Use drip plans. Hold long-term. Emotion kills returns. Compare allocation versus your goals. SCHD shouldn't be the only thing you own, but it can be a cornerstone investment during volatility. At the end of the day, smart investing isn't glamorous. It's disciplined. A boring ETF like SCHD can protect wealth, generate income, and reduce stress, even when the market crashes. If you want future videos breaking down dividend ETF strategies or crash-proof portfolios, comment "Safe Investing" below.
This video is for educational and entertainment purposes only and is not financial advice. I am not a financial advisor. Investing involves risk, including the loss of principal. Always do your own research and consult a qualified professional before making any investment decisions.